open then this morning, and the Adani group of names definitely is going to be in focus, starting off from Adani Enterprises to Adani Wilmar, Adani Ports, given that the BSE has now raised the daily limit of 4 of the Adani Group stocks. So some of these names are in focus. Adani Transmission as well, along with Wilmar, and Total Gas holds up higher as we speak. So does Adani Enterprises. For the Nifty, still not made it to that 18,700 print. 18,668 is where we're currently at. There's, of course, Hindustan Aeronautics as well. That's going to be the big mover this morning. And that's got the in-principle nod for a deal with GE to make engines in India. That is what news reports seem to be indicating. HAL starts off with a gain of 2.5% as we speak this morning. There's also couple of other names which are in focus. So, there's also an Alembic which has got a US FDA ANDA nod for one of the hypertension treatment drugs. So that stock is another one in focus. Engineers India, which has bagged a sizable order from JSPL and NALCO. So that's another stock also which we're keeping on our radar this morning. A lot of other stocks that we're going to be looking out for today. ICICI Lombard, their May premiums have come in higher by a good 21% on a year-on-year basis. Torrent Power, which has signed a 27,000 crore rupee hydro projects. So that's another stock which is in focus, and it's a solid gap up on Torrent Power, 7% higher as we speak for this one. Look at Tata Motors as well. Ahead of the analyst day, the stock is already at a 52-week high and still going strong. 557 is where that stock is. There's also Coal India. Remember, the FTSE weightage has gone in higher, and we're expecting inflows of approximately about $18.5 million in this one. Coal India, mildly in the green, but 0.6% higher regardless. Star Health, for that one though, the May growth has come in slower than the month of April, although that stock has seen in any case a stark underperformance, still struggling around that 540, 545 thereabouts mark. So that's pretty much the texture of the trading day. Let's also revisit what some of these cement and realty plays are up to, considering they were really the flavor of the day yesterday. Be it Ambuja, ACC, Shree Cement, Ultratech Cement, India Cement, the entire pack was holding up in trade. Today they seem to be a little bit of in a consolidative mode, though India Cement as well as Ultratech though seem to be pushing higher even now. Oberoi Realty, let's see what that stock is currently doing, because that's another stock which is going to be in focus this morning. Remember, yesterday too it was a big winner, and that stock has been holding up pretty well. By the way, a couple of brokerage upgrades as well coming in. Motilal Oswal, they've upgraded Teamlease now to a buy with a target price of 28.90. So that's indicating a good 34% upside. That stock starts off nearly about 4% higher as we speak right now. There's JM, which has come out with a note on Infosys as well. They're lowering their PER target to 20 times from the earlier 21x, and they're reducing the target price from the earlier 1420 to now 1360. Stock still at 1286 thereabouts. So these are a couple of stocks which are in focus this morning. And you may want to look out for what Cochin Shipyard as well is up to in trade, along with VATech Vabag, because it's a sizable order that VATech Vabag has got from Sidco in Maharashtra. So that's another stock in focus. And yes, a $5 billion deal in the brewing. We've seen how mighty excited the entire defense pack has been of late. And Mazgaon Dockyard, that's going to be a very, very important one, considering it seems a submarine deal with India could become a very flagship project, and that is the accord between India and Germany, which seems to be in the pipeline. Mazgaon Dockyard currently higher by over 1%. But Kunal, for the overall texture, it seems like once again it's going to be a day of consolidation, unless of course we move this way or that intraday.
Yeah, I think we're nudging to the higher point of the band, 18,650 on the index. So let's see the first half an hour or so. If the index sustains above this 18,650 mark, we could probably expect a better second half than what we've seen over the last couple of days. The stock which I would look to trade in the open would be on IndusInd Bank. A very attractive setup for the stock, breaking past about 1300 levels, and looks to be one of the stronger stock from the entire private sector banking pack.
Just checking in then on what's happening within the broader universe as well. You've got a gain of 0.5% coming in on the mid and the small cap. So clearly that outperformance continuing. Torrent Power scales up a solid 7%. You've got Rail Vikas Nigam as well. That's chugging along at 125. EIL in the spotlight. That stock is gaining some traction. HAL, IRCON, so some of these defense stroke rail related names are up and about in trade this morning. Dishman Carbogen, MMTC as well as JK Lakshmi Cement. What about you, Naresh? Let's get in an outlook on the first trade that you're punching in.
So, adding on to ACC Limited, the stock is setting up for a short-term breakout above the 1870 mark. At 1850, it's a good risk-reward trade with a stop loss at 1820.
I'm just going to refresh my screen as well and tell you what the big movers are within the F&O pack this morning. And while the Nifty, of course, is having a bit of a quiet start, you're seeing HAL, which is now up 3%. There's MFSL, which is also holding out very smartly. Glenmark Pharma is making a 2% move. There's ICICI Pru Life, which is up 2.25%. And then there's Britannia, which is also holding up 1.5% as we speak right now. The losers, Oberoi Realty, given that this was a big buzzer yesterday, that's fallen. JK Cement seeing some profit taking. Idea, Polycab and M&M Finance are some of your laggards in trade. Kunal, anything that you could identify when it comes to a trend with cement or realty? Because yesterday's move doesn't seem to be following up through.
Yeah, I think for the large cap stocks, they would probably take a bit of a pause. But I think names like Ultratech Cement, Ramco Cement, etc. The charts for these stocks are very strong and robust because they've managed to stood the test of the last 3-4 months of price volatility as well as a very good comeback. So I believe eventually these stocks should start to move up higher. From the real estate pack, I would still be bullish on the likes of DLF and Anantraj Industries. I think both these stocks are looking quite strong in terms of their respective charts. Other names from the rest of the pack, I think Oberoi Realty is the other stock which has also made a good comeback, trading above the 200-day moving average, showing signs of a golden crossover on the daily charts, which is again a very good technical phenomena for many of the stocks. So would be bullish on the real estate pack, specifically DLF and Anantraj.
Okay, that's the view coming in on some of those cement as well as real estate names. Meantime, let's get in a take from you, Naresh, on the Nifty Bank Index in terms of tracking levels and how you're looking at individual performers.
So Bank Nifty is on verge of a breakout above that 44,400, 500 mark. Looks promising. Expecting HDFC Bank to take a reversal from this area of 1600, and that could prop the Bank Nifty higher. So overall, looking at continues to be the same IndusInd Bank as Axis Bank to be leaders, but there could be a bounce back in HDFC Bank from here on.
Some of the names like New India Assurance, 3.5% on that stock. GIC, for instance, is a buzz. HDFC Life, ICICI Lombard, SBI Life. Kunal, any of these stocks catching your eye?
Well, I think HDFC Life could be interesting. That stock had been a bit of a laggard over the last 1.5 to 2 years, not just over the last 2-3 months. That stock has made a good comeback. I think almost a week or so back, the stock was almost at the 600 levels. And then from there, it corrected. So maybe it's a bit of a cool off from that strong psychological mark of 600 for HDFC Life. I think at 580, 585, it could be a good time to try and buy the stock, anticipating that this time around the stock would break past about the 600 levels.
FMCG is seeing a bit of a renewed vigor, if you will. Britannia is now up 2% as we speak right now. And I can see Nestle as well dash up higher. It's a solid 1% move that stock as well is seeing. And Kunal, this one's really going from strength to strength, right? Britannia, I mean, it's been a fabulous performer all through last year and continues its up move.
Yes, Britannia, Nestle, I think these stocks have done exceptionally well. And what this last 2-3 months of move has done is, even the likes of HUL, for example, the stock which was an underperformer and I think remained into a very sideways kind of a trading range at 2,200 approximately for the last 2-3 months back. That stock has made a good comeback. Look at the charts for Dabur in the last 2 months. I think that stock has risen up by more than 15% from levels of I think 500 approximately. So that also looks very interesting. So it's the entire sector which has started to shape up well. Yes, Britannia, Nestle, these are the ones which are more leaders in terms of price performance. But there are other stocks, the other beleaguered large cap names, even they are making a good comeback.
Right. Okay. Let's move on and let's also discuss some of the other trends as well. And Kunal, I'm going to come right back to you. Let's also talk about the underperforming pocket. While today, of course, you're not seeing a follow-through come by from cement, telecom, real estate, media, even oil and gas, pharmaceuticals, autos for that matter, they're in a bit of a pause mode. But Kunal, just individually when it comes to banks, because for the index to move up higher, I'm guessing more banks would have to participate into the rally. What is your assessment of the constituents of the Nifty Bank, and what would continue to consolidate, what would underperform, and what would outperform from here?
I think that's a very interesting question because over the last two months specifically, we've seen one pattern which is very clear, that the large cap private sector banks are clear underperformers. Now, I'll give you an example. For example, 2 months back, Axis Bank was trading at 840, 820, 840 levels. ICICI Bank was almost at 900 plus mark. In the last 2 months, ICICI Bank is still at 930, 950 mark, but Axis Bank has moved up significantly higher and is now inching closer to the 1000 territory. So you've seen that clear outperformance coming out from the tier 2 banking names as compared to the large cap private sector banking stocks. Same is the case with IndusInd Bank, and then you can probably add even the likes of Bandhan Bank, RBL Bank. The way these stocks have performed, moved up more than 20-25% in the last 2 months or from their March low. So that itself tells you that the mix of the banking stocks is not the traditional mix where large cap stocks are outperforming, but it's the tier 2 large cap names and the mid caps which are outperforming. So, and again, it's very difficult to anticipate that what point will these large cap stocks start to fire up. But I would believe that it always makes sense to go with momentum, and the ones which are riding on high momentum are the likes of Axis, IndusInd, as well as the tier 2 private sector banking names.
All right, Naresh, get in your take as to what the outlook is when it comes to the entire real estate space after days of picking up pace, seeing a bit of softness here?
So the trend is clear. We are seeing one by one different stocks give a breakout in the real estate space. It has been DLF which has been a leader, but if I look at, say, Prestige, the stock is very coming close to a new all-time high. 500, 530 has been a problem zone for the last 1.5 years. So that looks promising. Prestige could be one. Then there is a Kolte Patil which saw a retest of the same lows of 250, now coming very close to the all-time highs and the last 2-year range of 350 to 380. So structural breakouts being seen a lot of real estate names possibly. So it's a sector which has finally turned around in terms of momentum. So you want to be buying on dips. So out here would be liking Prestige, which is near a breakout, and on declines it would be Kolte Patil.
Right. Okay. That's the take coming in on some of the realty names. Just want to see some of the other reactions that you're seeing on individual stocks. And let's see what the Adani Group names are up to. Those stocks will just come up for you on your screens next, given the circuit filter changes. There's ICICI Lombard as well, wherein the May premiums have come in higher by 21%. Excuse me. That stock is holding up about 1.3% as we speak right now. Torrent Power, sizable 27,000 crore rupee worth of hydro projects which have been signed. So that stock is holding out very, very steady, 7.5% uptick coming in there. There's Tata Motors, obviously. They've got their analyst meet today and the stock is already positioned at a 52-week high. So that's another stock which has been holding well. And then Coal India, wherein the FTSE weightage has actually been upped and the expected inflows are to the tune of approximately about $18.5 million. That's another stock which is holding up in trade. But the big question at an index level is the Sensex at 1 lakh a possibility, and how soon could that happen? We pose this particular question to the biggest market voices. Here's their opinion.
Yeah, that to me is very reasonable. Yeah, very. I would be disappointed if the Sensex had not touched 100,000 5 years from now.
I'm absolutely certain it will reach 1 lakh. Now, whether it happens in 4 years or 6 years, frankly, is really a meaningless debate. But looking at the nominal GDP growth rate, which we are looking, you can safely say we can grow between, say, 12 and 14%, maybe 10 and 14%. You will approximate that number, and if you compound it at that, so in 4 years, roughly from 60,000, you add another, say, it comes to approximately 1 lakh in 4 years. I mean, it's not a reach to see 1 lakh, just at the simple compounding of the nominal GDP rate. I think it's a given, 100%.
Market को predict करने की कोशिश मत करो. More often than not, you will be wrong. but
All right, let's get a move on and bring on board a very special guest. We've got Rhythm Desai, MD, Head India Equity Research at Morgan Stanley, joining in to share with us his outlook on the markets. Rhythm, thank you so much for taking time out and joining in. And I guess I'm going to take off from the latest note as well, talking about India's transformation and its implications. In terms of where India stands, given the fact that we are looking at the manufacturing renaissance taking place, the fact that there is a capex that is resurgent, where does India stand at the current juncture?
I think from an economic cycle perspective, we've just started a new economic cycle, and I think it has many more legs for a nice run. We've actually made significant changes to policies over the past few years, which has set the stage for this resurgent economy. It will likely be led by investments, so I think you should expect pretty strong private capex. Government capex has already been good, and I think that will stay at good levels. So it's an investment-led recovery in the economy. Its concomitant effect will be on increasing loan growth. The starting point of corporate balance sheets are very good. Corporate debt to GDP has declined considerably over the past 4-5 years. So I think we are in the midst of a loan boom. And I think we should also see pretty good conditions for consumption. Though I think, as I said, investments will likely lead the economy in the next few years.
Talking points in their Rhythm. But tell me, how's the mood when it comes to India on the sidelines of the conference? Is the Josh high when it comes to India? What have you been gathering?
So let me actually talk about interactions going past the past, say, 6-7 months. It would seem that from all areas, there is very deep interest in increasing stakes in India. So whether it's private equity funds, whether it is multinational companies, or it is foreign portfolio investors. And I think we are seeing interest from everywhere. And the interest levels actually are significantly higher than I've ever seen, especially when we talk about long-term investors like private equity funds and multinational boards. So I've been interacting with more people in the last 6 months than I cumulatively have over the past 10 or 12 years. And I think all this will translate into pretty strong flows in the coming months, especially on the long-term side. Foreign portfolio investors are also driven by conditions in other markets and expectations elsewhere. And as emerging markets seem to stage a recovery October last year, India started underperforming, especially given how depressed the valuations were in places like Korea, Taiwan, and China. That outperformance or underperformance for India ended in March. We saw pretty good correction in relative valuations, and I think the momentum is now shifted back to India, and you are seeing it in terms of flows. So the foreign portfolio money tends to look at India from a more short-term perspective, but even that short-term looks encouraging. I mean, the earnings season that has gone by has produced pretty strong earnings, and I think the outlook for earnings remains very strong. And India is one of the very few places on the planet where earnings growth will be well into double digits. So I think it will attract money, both short-term as well as long-term.
Are there any sort of concerns around rich valuations, or I should say relatively rich valuations as compared to our other global peers?
Yeah, the headline multiple, both absolute and relative, are high, and that has been a constant pushback for investors. But as I keep telling them, because we have a strong growth story, and the market knows that, it's not oblivious to the fact that there is a strong earnings story for India. It will always look like it was attractive with hindsight. So when you go forward 1 year, you'd say, oh, way back in April last year, May last year, valuations were quite okay because there's so much growth that India has generated. So I think this is the nature of a new earnings cycle, which is that it is very difficult to get low headline multiples measured as PE ratios, by PE ratios or price to book ratios. And that challenge will remain for investors. They'll have to look through that and make a slight, they'll have to actually rely on their confidence about the future in order to jump into stocks. But that challenge remains, and I don't think it is going to go away very soon.
Talk about the targets on the equity markets for the year end. What is it that you're penciling in when it comes to the Sensex and the Nifty rhythm?
So I think the context here is that India is amongst the top 5 equity markets in the world. So it's not a small cap stock in the global context. It's a large cap place. And we are not so constructive on some of the large markets around the world. So especially in the US, where we think that stocks may go through a painful period. We are positive on Japan, and that is certainly a comparison for India. But when I look at what my core strategists are forecasting for their respective markets, I think we still have a return expectation on India that is largely higher than all of them. So I think we can expect a pretty strong return for the rest of the year going into next year, maybe in double digits. And I think it is possible that the market walks into 2024 and starts pricing in a majority government. And if that happens, then I think we will witness pretty strong conditions for the equity markets, at least until some signs of where the election results are going to come through.
What are the risks, though, to your bull case target of 80,000?
No, there are plenty of risks. I mean, we should not focus on the bull case. We should focus on the base case. But anyway, there are a lot of risks on the horizon. We have to first deal with the immediate weather problems that we may face, the prospects of an El Nino and depressed rainfall. As such, I don't think that will have an impact on the economy unless the rains are really bad, something like 15% below normal, which is not the current forecast by any agency. But we have to keep a watch on that. We also have to keep a watch on how global growth pans out. There have been steep increases in interest rates over the past few months, and there will be impact on global growth. While at Morgan Stanley, we don't think the Western Hemisphere is slipping into recession, growth is going to be pretty sluggish. And our fourth quarter 2023 GDP growth forecast for developed markets is like 0.5%. India exports more than 20% of its output. So there will be some effect of that. And growth is likely to be slower than last year, as is evidenced by our forecast. So that's another challenge which we have to face. There will be a fair bit of political news flow. There will be state election results that will come, and the market will probably react to such events on a short-term basis. And of course, then the big elephant in the room is what happens in the general elections next year. And we don't know what happens. And if the country chooses to put in a minority government which is less stable, that will also leave some impact on the market. So there are enough risks to ponder about.
Rhythm, we're very accustomed to the kind of infrastructure development that we see all around us and in the country as well, given the kind of thrust and the impetus that the government has put on infrastructure as a whole. In light of the kind of progress that we've seen, the fact that there has been a pickup in pace of infrastructure development, what's your outlook on this sector? And if I could broaden that to the entire industrial space as well?
Yeah, so as I said at the outset, I think this is a new investment-led economic cycle that we are at the beginning of. And investments, particularly in the private sector, are starting from pretty low levels. In the previous cycle, in the first decade of the millennium, we went from 4% of GDP and peaked at 17. We're around 5% right now. So this number could go well into double digits in the coming 3 or 4 years. So it's a very strong outlook for industrials. I think you will see order books going up everywhere. They are already going up, and that momentum and that trend may continue over the next several quarters. Of course, from a stock market perspective, we have to continuously judge what's priced in and what's not. In some industrials, the coming growth of the next 12, 18 months is likely priced in. In others, it's not. But I stay constructive, and we are actually overweight the sector. So it's a good space to be engaged in.
Overweights. Rhythm, just wanted to understand, aside of industrials, what are the other sector overweights that you have?
So as I said, I think we're the throes of a loan boom. Given where we are starting on corporate debt to GDP and given that we may be seeing a pretty strong investment cycle. So credit growth could be materially higher than what we've seen over the last 10, 12 years. And that should favor financials. Within those, I think at the moment at least, because our view is that the rate cycle has peaked, the non-banking lenders may see a better margin situation than the banks. So the banks will have to go through some consolidation in NIMs or maybe even a decline in the coming 12 months. And to that extent, I think the NBFCs look like a better space. But with the 3 to 4 year view, I think all the lenders are going to have a very good time. And generally speaking, we are bullish on the financials and overweight. In fact, it is our biggest overweight and most strong recommendation that we are making to investors.
Standout factor when it comes to automobiles and PSUs as a sector, Rhythm?
Okay, PSUs is not a sector. Obviously, that is a ownership classification. Public sector companies come in various sectors, so I think we'll have to go into each of those sectors. I am constructive on discretionary consumption, so I think autos lead the pack. We've been bullish on them for quite a while, and I continue to stay bullish on autos. I think we have a positive view on real estate as well, and other areas of discretionary consumption. Also, what I'll make as a point here is that I think rural consumption has seen its trough and should recover quite smartly in the coming months, with the only one caveat that we don't get a terrible rainfall season. And if that happens, then I think rural consumption-oriented companies will also do well, and the stocks of those companies are also worth watching out for. So lots of areas in the market which look good. What doesn't look good, I think, is global-facing sectors, especially in the commodity space. I think given the softness in global growth, we're likely to see soft commodity prices, and it'll be a while before those sectors trough out. IT services, I think, is a mixed bag, but I would generally be constructive. I think even though there is a slowdown in growth, we may not see the same type of tech spending cuts as we saw in previous US growth slowdowns because of the structural tailwind which comes from the spending that companies need to do for digital and AI.
Rhythm, it's intriguing as to why you're overweight technology right now. Yes, the chatter from both TCS as well as Infosys during their annual days was extremely strong, and they said that AI is nothing but a huge opportunity for Indian IT and they can surely cash in on that. I believe Infi AR had the word AI mentioned 46 times. But tell me, do you think there could be another quarter or two at least of damage, or are valuations now lucrative enough to start nibbling into this sector already?
So one thing is the pecking order thing. So I would favor financials, industrials and consumer discretionary over tech. So that will be fourth in the pecking order. The second is I would concur with the companies if they say that artificial intelligence is a huge opportunity. This is very similar to when ERP came and a lot of people thought that it was curtains for Indian software companies. Then cloud came and people thought that Indian companies will not be able to transition and there will be a cutback in their ERP revenues and a slowdown in earnings. Both views proved to be false, because in the initial stages of a new technology rollout, there is a huge amount of coding that has to be done. And nowhere on the planet can you do it better and cheaper than India. So India will see a rush of business as companies build out their digital and AI strategies. After 4 or 5 years, or maybe 5 or 6 years, I don't know exactly when, that spending peaks out. And then I think if no new technology emerges on the horizon, maybe that's the time when IT companies will start seeing a perceptible slowdown. So this is the midterm structural view. Now, coming to the near term about the next quarter or two, yeah, there is a likely slowdown and there is cutback happening in America. There are jobs being lost. But it's not like the American economy is down spiraling into a recession. It's not our base case view. So if we do get a recession in the US, which is a bear case view, then there will be further downside, and I think IT stocks will get tested on the downside. But since that's not our base case view, I think the likely slowdown in spending is already baked into the share prices. So I think it's a good place to be. And in a portfolio context, I think you want to own IT. It may not be the only thing you want to own, but if you own financials, discretionary and industrials, I think IT operates as a nice barbell.
Rhythm, the other thing is that the opinion and even the stock price moves are getting very split and divided when it comes to banks. You know, a lot of conjecture out there on whether or not the credit growth is going to top out in a sector or two, or whether it already has. And you've got a very varied performance as well from the corporate facing as well as the retail facing banks. Just wanted to understand within banks, how do you maneuver through the sector?
So I don't think we're anywhere close to topping out of credit growth. I think we're just at the beginning of a new cycle, and there is a multi-year process in front of us when credit will build up. You know, corporate debt to GDP, as I cited, is at 50%. And I think that number will be materially higher before this credit cycle is over. It will go into the 80s, maybe even the 90s. So it's not like this is, ending anytime soon. Retail credit also is, I think, likely to rise, and this tussle between corporate and retail will remain on a near-term basis. But I would encourage people to look beyond that and just focus on the medium term. The next 3 or 4 years, I think, are going to be very good for banks and non-banks in India. In fact, for all classes of lenders. And I think it's not a place you want to get too cheeky about and trade for a quarter or 2 here and there. You could end up missing out on those stocks and they may run away from you. So I would be structurally very positive on financials.
When it comes to the entire energy basket, where does the preference lie with domestic versus global cyclicals?
So we prefer the domestic cyclical stocks. Cement clearly over steel. And I would take a little bit of a backseat on energy. I think it's going to be a difficult environment. As I said, global facing sectors are going to face, especially the commodity ones, are going to face a bit of rough weather in the coming quarters. But cement, I think, is in a good place. Demand conditions are very strong in India, and there is good pricing discipline. And most importantly, not just for cement, but for a lot of sectors, raw material costs are going to be significantly lower year on year. A lot of the high cost inventory that companies had acquired last year because of the spiraling of raw material costs is now exhausted. And you will start seeing the benefit of falling raw material costs in their earnings. So my earnings estimate for the market, for example, remain much higher than the consensus, because I don't think the consensus has fully appreciated how much raw material costs benefits are going to come through in the next, say, 1 year or so.
Finally, Rhythm, given the kind of inflation projections that you have, what's the outlook on the rate trajectory down the line by the Reserve Bank?
Yeah, so as I said, we think the rate cycle is done. We don't expect any further rate hikes. In fact, we don't expect rate hikes in America either. So we think the rate cycle is done even in the US. And in India, I think as you go into the early part of next year, maybe we will see a rate cut as well. The economy is on a very good footing. I think the RBI has done a brilliant job in managing macro stability in a very tricky global environment. And we've come through largely unscathed. Inflation is decelerating, and much of the policy work has helped. And I think we are probably done with all this.
Rhythm, appreciate your time. Thank you so much for joining in and sharing with us your valuable insights on ET Now.
Thank you.
That's the take coming in from Rhythm Desai. A base case probability of 68,500 on the Nifty, on the Sensex, a bull case of about 80,000, talking about double-digit returns as well on the markets for FY24. Financials, consumer discretionary, as well as industrials and technology are some of the sectors that they are closely looking at with an overweight stance. A quick check-in on the index with news that we're at 18,661. We'll take a quick break. Be right back.
Back with the market right here in ET now. Let's just revisit where the market has settled in at, and what looked like a very, very tempered start continues to be so. Although the good news is that at least on the Nifty futures, we've made it back to that 18,700 print, still eluding us when it comes to the Nifty spot though. But yeah, look at the strength in some of the FMCG names, especially a Britannia, 2.5% higher there. Nestle holding up 1.6%. And then, of course, there are others like an L&T, Tata Consumer, there's Apollo Hospitals, Hero MotoCorp, Infosys. They all also continue to be very, very strong in trade. But let's shift focus and let's talk about Equitas SFB, and let's talk about how their Q4 has panned out. P.N. Vasudevan, the MD and CEO at Equitas Small Finance Bank, joins in on the show right now. Mr. Vasudevan, great to have you today on ET Now. You know, rates have likely peaked, but the rise of rates has been quite dramatic. In this environment, you've grown at 35%. What's been the impact that these rate hikes have had for you on ground? And do you expect to continue to grow at this kind of a healthy pace?
Yeah, good morning. The rates have been going up, and our own cost of funds, if you have noticed, has gone to 6.6% for the March quarter ending. And the old deposits are still getting repriced. I mean, we still carry a large amount of old deposits at low rates, and they will get replaced with the new deposits at higher rates. So we believe that the rate could go as much as maybe 7.2% over the next 2 quarters from the 6.6 that we saw in the month of March. But on the ground, in terms of demand, since we are largely focused on the informal economy borrowers, and the ticket sizes are very low. Our average ticket size, if I remove microfinance, the average ticket size of lending is just around 6 lakh rupees. So in that space, the unmet demand continues to be quite large in all the markets that we operate. So yes, last year we had a growth of 35%, but that was because it was a low base coming off the COVID period. This year, we expect we should be able to grow at anywhere around 25% plus.
Right. Mr. Vasudevan, do you see these higher rates impacting credit costs in any which way? And I mean, could there be a downside risk to macros among other factors? And could that really create problems for your balance sheet?
Normally the fact is that when interest rates go up, it actually should impact the credit capability of a borrower because his EMI suddenly goes beyond what he can repay. But in our case, as I mentioned, our disbursement ticket sizes are really small, 6 lakh rupees, and the tenures are also reasonably short. Our average, tenure, normally it goes around 5 to 7 years. So that way, a smaller ticket size and a shorter tenure means that the impact of increase in interest rate is not very high from an EMI perspective. So we don't expect that the increased rate should have an effect on the credit cost.
Vasudevan, morning now. An outlook on your deposit growth, because that has managed to hold out despite a tough environment. What is it that Equitas is doing differently? Is it the rates that you offer, and do you think that these rates are sustainable?
Yeah, so we do offer a rate which is obviously higher than the large banks. We are a smaller bank, and we are of course a newer bank. So it takes time for the brand to get established amongst depositors. But if you look at the pre-May of 2022, the peak interest rate that we were offering and the peak interest rate that the large banks were offering, the difference was as much as around 2.5%. And today that difference is actually narrowed to about 1.7%. So we have effectively, what it means is that we have increased our deposit rates, but at rates lower than the larger banks, narrowing the gap that we have with them. So I think that kind of a rate is sustainable from a lending perspective. And in terms of deposit growth, last year we had a 34% growth in deposit. This year we expect another anywhere around 25 to 30% growth in deposit to come in. And retail term deposit is something that's really doing very well. CASA is under stress, and I believe that CASA is going to be under stress for some more time, simply because the attractiveness of putting money into deposit is so high that people are likely to move whatever money they don't need in savings. They will want to move into deposit to earn a better rate. So CASA could pressure, but retail deposit is doing well. So overall, we believe that deposit pace should keep up with the advances growth pace.
Okay, so that's a take coming in as far as the loan is concerned. But sir, wanted to get a take with respect to the leadership as well, because that remains very important for the entire sector as well. So for your own company, I know you have given the indication earlier that you would like to continue as the MD and CEO, given the fact you're still eligible. But anything that you've heard from the RBI on it yet? Okay, we'll try and get more details as far as that is concerned. Maybe my audio is not clear. Guys, do you want to get a sense?
Is frozen. We will get back to Mr. Vasudevan. Has it? Yeah, we will get back to him in just a second from now. But yeah, wanted to understand, the current tenure of Mr. Vasudevan is coming, is very close to ending. So what's the progress on the extension is something that the market definitely wants to know. We will just get back to him in seconds from now. Are we getting him back anytime soon? Okay, we will just get back to him in just a second from now. But yeah, like we've been highlighting, their performance, of course, has been extremely strong. They've seen an NII growth of about 25%. OPEX has risen up about 31%. Credit costs have come down by 26%. PAT has seen a 104% jump. Of course, it's a smaller base as well that we are talking about. But the small business loan also has advanced and crossed that 10,000 crore mark as well. And disbursements continue at life highs. You know what? While we get back to the management of Equitas Small Finance, let's hear out from Jonathan Garner from Morgan Stanley and what he's making of India as of now.
Well, the earnings growth outlook is good. Our colleague Ridham Desai has a convincing case that earnings compound annual growth rate can be around 20% plus on a 3-year forward basis. And the companies are executing well. The issue is really around valuations. So last October, when Korea, Taiwan and China were so cheap, the Indian market, if you look at, say, Sensex on a forward PE basis, was at very high valuations, and MSCI China almost 23 times forward PE, a near record valuation premium to Korea or China. Now that gap closed through the Indian market having a relatively poor performance late last year and early this year. So by the time we got to the end of March, we actually upgraded India from an underweight to a neutral, and it's now right at the top of our neutral recommendation. Albeit that the valuations are about 1.6 times that of overall emerging markets, that's still above long-run average premium. The Indian market typically enjoys a premium to other emerging markets, but last October it was at a record, and that was too rich.
Right. If we were to talk about flows, I mean, you speak with some of the biggest global asset allocators who are looking at good opportunity. When you're having your discussions, what is the sense you're getting on flows? Which are the kind of markets where flows will actually go as we go ahead and the rate cut cycle starts maybe in the next 6 to 8 months ahead?
Well, it's a complex situation. Yes, you're right that interest rates are an important part of it, but geopolitical risk is something that investors are also very focused on because that affects the cost of equity or the valuation. And certainly what we're seeing is that for Japan in particular, that geopolitical risk situation is probably at the margin helping drive a wide range of investors towards Japan, both developed investors and Asia specialists. Whereas for China, really, ever since February and with the further deterioration in the geopolitical risk environment, particularly the relationship vis-a-vis the United States, that risk premium has been built back into the China market. It does leave China, though, now trading close to an all-time low valuation relative to other emerging markets. So we have to think about a multiplicity of different features when we put together our individual market targets and also our target for the asset class overall.
Jonathan, I'm really happy that you brought up that point of China, because there's a China versus India equation always playing out as far as emerging markets and watchers, at least here, are concerned. We saw a lot of money chase Chinese stocks because they had gone way below their fair value earlier, a few months back. But that seemed to be reversing. Do you see that more juice in that trade? on valuation, quality of earnings and growth, the flows may continue to come out of China and go to India, or you think bulk of that trade is already wound up?
Well, as I just mentioned, the China market is back to being exceptionally cheap versus other emerging or Asian markets. I wouldn't really characterize it as flows from China towards India. If anything, what we've seen more is flows from China, in fact, towards the Japan.
Okay, so that's a word coming in from Jonathan Garner, but let's continue our conversation with the management at Equitas Small Finance Bank. Mr. Vasudevan is still with us. Mr. Vasudevan, before we got into that technical glitch, I wanted to understand from you with respect to the succession plan. I know it comes for renewal in the month of July. What's the update with respect to that? Have you put in the application? Have you heard anything back from the RBI?
Yeah, so we have applied to RBI for a 3-year extension. The last extension is expiring in 23rd of July this year. We applied for a 3-year extension and we are awaiting the feedback from RBI on that.
Usually, how much time does it take? Have they come back with any questions, or what's the base case expectation that you have?
Oh, I think we have to just wait for the RBI feedback. Normally we can't really share any dialogues with anyone else. But it takes about it takes a few months for them to process and get back. So we generally end up applying fairly in advance also, and so we should just wait for the feedback to come from RBI.
Mr. Vasudevan, then you could tell us, what really is happening in, say, the next 3 years. And I don't want to talk quarter and quarter here, but the longer term, vision that you have. Where is it that you see Equitas SFB in terms of your book size, in terms of what the mix could be, whether the sustainability can be expected when it comes to your ROAs, your NIMs, your credit costs, etc. What are the assumptions that you've made at your end for, say, the next 2 to 3 years?
See, basically, we converted into a bank about 6 years back. And, the cost of funds, the landed cost of money that we calculate in Equitas, which is the cost of interest cost plus the cost of raising that money plus our SLR CRR cost. If you take all of that put together as a landed cost of money, that has been coming down. Obviously, it's been coming down over the last 6 years. It was as high as 13% just as soon as we became a bank, and now it's around just over 8%, 8.2, 8.25%. And that is expected to go further down as we keep mobilizing deposits at a rate higher than the increase in the cost of raising that money. And as our landed cost of money comes down, more and more avenues for lending also opens up. Equitas is very strong in the informal sector economy lending. So we have a range of products. We have the small business loans, which is about 37% of our book. We have the commercial vehicle and the used car financing, which is about 25%. We have the microfinance, which is about 18%. We have the affordable housing, which is about 10%. And then the MSC, working capital financing, which is about 5%. So we have a broad range of lending products. It's a very broad-based platform that we are lending, building the infrastructure of the bank on. And each of the markets where we lend has a high level of unmet demand, significantly because of the fact that they are from the informal and difficult to lend and difficult to collect. So that acts as a natural entry barrier, and there's a lot of unmet demand in that space. So we believe that given the fact that we have the ability, we have the capability built over the last 15 years to address that segment, and given the fact that our landed cost of money has been coming down consistently over the last 6 years, and expected to go further down the trajectory over the next 4 or 5 years, and no more areas of lending opportunity opening for the bank, I think on a combination basis, around 25% growth is something that we should be able to look at for the next 3-4 years.
Before we let you go, Mr. Vasudevan, what's the prospect with respect to the universal banking license? What's the strategy? Any timeline on that?
We had to complete the merger of the holdco with the bank because that was one of our licensing conditions, and we've just completed that recently in the month of February. So we are in touch with the regulators, and as and when we get a permission to apply for the universal bank, then we will end up applying. So obviously there are no timelines, but as and when the window opens for us, we will definitely look to apply.
Mr. Vasudevan, great to have you today on 18 Hour. Thank you so much for taking the time out.
Thank you.
Okay, let's move on. Let's talk to now the management of. We've got Five-Star Business Finance joining in on the show right now. Let's talk to them about, what really is happening with the business, what's the opportunity in secured as well as small loans, and what is the potential of scalability really. We've got with us Lakshmipati Deenadayalan joining in on the show right now. He's, of course, the CMD of the company. Mr. Lakshmipati, great to have you today on ET Now. Just wanted to understand the market opportunity in this particular segment that you cater to is huge. There's no denying that. And we've seen your own AUM grow strength by strength over the last few years. Do you see a long runway for growth ahead? And will you be able to sustain an AUM growth of, say, over 30% even in the years to come?
First of all, thank you for having me in this show. I'm happy to come again in ET Now and explain to the viewers about the specialization of Five-Star in lending to the unlent segment of this country for the last 20 years. Yes, absolutely, you're right. We have a bright and a very, very long runway. Because this segment has not been, that credit need of the segment has not been met by the banks and bigger NBFCs. So we find a lot of opportunity going deeper into the existing geography where we have strong presence and getting to the newer geographies where we have not yet put our footprints. Taking this long runway and created one of the best execution team to cater this model, I think we may revise the guidance from 30% to 35% for next 3 years.
Interesting. What is your own sense on how the demand is on ground? And especially if I could talk about how you're likely to see the credit demand shape up for the next few quarters.
See, the demand, I was speaking to your channel sometime back, so I emphasized this point. The first port of credit for the customers whom we serve, single small shopkeepers and self-employed in tier 3 to tier 7 towns, was being catered by the local money lending community. So the demand was always there pre-COVID, during COVID, and it will be there. The strong demand will be there years to come. So it is a player who can go and tap this market successfully. From Five-Star perspective, we always have approach of collection first. This is not a growth first business model because growth is very easy for a lender, but it is very difficult to collect it back and maintain the asset quality consistently at the best levels, differentiates you from others. So as I said in the earlier question, the credit demand is always there and we'll be catering to these customers as we move on.
That's exactly my question, right? Given the industry, it's always the biggest headwind with respect to how you're able to maintain the asset quality. You're talking about how collections continue to be quite strong, but if you could give us some guidance in terms of how the asset quality is likely to pan out, the asset ratios, etc. Any indication for FY24?
Before giving my guidance for FY24, let's understand the basis of Five-Star. The business lending model of Five-Star is born from the collection first. So this is not a business first model, it's a collection first, then comes your underwriting, third comes your growth. Because growth is always there for lender in the country of our size, and people have not come to the formal credit side. So you have always a big opportunity whenever you want to start lending. But Five-Star has clearly defined itself as collection first NBFC during good times and during bad times. So our asset quality was always best, not recently, for last 15-20 years. Whatever the NPA classification was described by RBI, that it be 180 days or 90 days or the recent change in NPA categorization, Five-Star's asset quality remains always strong. So our guidance to the market is the credit cost for financial year 24 also will be at close to 1 to 1.25%. So we will maintain the best asset quality even coming years. We don't see any threat because inflation is under control and the rates are almost stabilized. We strongly believe there will not be any rate hike, but we also believe the rate dropping down will take its own time, depending upon what RBI thinks. So we see a very strong cash flow in the hands of the customer that will reflect in our asset quality as the years goes.
Since you talked about the RBI, action going forward, of course, the decision will come out tomorrow for the RBI MPC meeting. What's your own base case expectation of have we peaked out when it comes to interest rate? What's the impact you're expecting on the microfinance industry for your own business?
My expectation comes from the report, what I read and hear from the channels like you, where most of the people say the rate hike pause, which was given in last time, will continue. But whether the rate down cycle will start immediately, I think we don't have any clues on that. The best case scenario says is it may be the December of this financial year or the first quarter or the last quarter of this financial year we can expect some decent rate drop from regulator if the inflation and the macro economy is better.
Okay, just wanted to also get in your outlook then as to the plans to expand to the non-southern states as well, given that demographics vary very differently in different geographies. Do you think that you can see the same success that you saw in the south in some of the other geographies as well? Is there any plan on the cards?
Yes, I completely agree the statement what you said. The demography difference is always there. Even within south, all the 5 states are not equal. Every state has own characteristic, cash flow, and legal or property nuances. So you have to learn that. Having said that, we are now strongly present in South, not deeply present. We expect to open 50 to 60 branches year on year for the next 5 years in South alone. So the market has such a huge potential in the existing South. Having said this, our non-South plans are very strong. So you will see a lot of activities getting into newer states and deepening our presence in the states where we presence stronger presence in non-South like MP, MH, Chhattisgarh, and newer geographies like Rajasthan, Gujarat will definitely take place in coming years. So we expect to be a quite good presence in non-South in next 3 years.
Thank you so much for taking time out and joining in and giving us a view on how business is shaping up. That's the management of 5-Star Business talking about how they are looking at a collection first model. That's the approach. Credit costs will be between 1 to 1.25% for FY24. Time for chart busters then. So let's find out what it is that our chartists are picking out for the day. Naresh Mirani and Kunal Bothra joining right back. And Kunal, let's discuss then your chart for the day. You're looking at an auto stock. Which one is that?
Well, yes, Savan, and it's an interesting stock because over the last many weeks, this stock has been silently moving up higher, and that's Hero MotoCorp. The reason for flagging of the stock is because on the weekly charts, it's come at a very crucial kind of a breakout. Now, this in classical terms, we call it as a double bottom pattern for a stock like Hero MotoCorp, where the stock retested the supports twice. This was in 2022 start, where the stock bounced off from 2,200 levels. This was very recently, just about 2 or 3 months back, when the stock bounced off back again from the 2,200 mark. So this establishes a very strong support zone for Hero MotoCorp on the medium-term time scale. And then when you look at the stock heading towards the resistance, this is the third important retest towards the resistance. So as you can see, first was again in start of 2022, mid 2022, and then the recent retest of the previous swing highs. Generally, we say that the third retest of the previous highs generally leads to a breakout. So we could be looking at a completion of this double bottom pattern breakout for Hero MotoCorp, which should be a potential at least a 600 to 700 point up move for the stock in the next 3 to 6 months. So for traders who have a longer term or medium term kind of a time frame, could look to bet on Hero MotoCorp, because on the completion of this pattern, there is a strong probability that the stock may come very close to its previous highs of 3,500 and beyond.
Okay, so So that's the auto stock that Kunal is betting big on. That's Hero MotoCorp, expecting a big breakout. But what about you, Naresh? What are the charts that you are spotting for us?
So that would be a chart for ACC. Now, if we look at the stock corrected from almost 2400 levels all the way down to 1600 to 1700 zones. Post that, the stock has gone through a sideways consolidation for the last 4-5 months. Now making a classical triangle formation, which has a breakout around 1860, 1870. So it's a risk reward trade with a stop loss at 1820 and a target price of 2000 to 2200 in the short term.
Okay, there you have it. Those are your chartbuster calls, Hero Moto and ACC. But let's find out some other top recommendations then that our chartists are flagging off. Kunal?
AP Capital is the first stock which I believe is making a good comeback, back above 170 mark. So it's a buy, 180 is the target, stop loss at 168. And second would be a buy on L&T, again a formidable comeback. In fact, 3-4 days back I had given a buy. The stock has moved up towards 2,300 mark. So would suggest a further buy on L&T at current levels. 2,400 could be a revised target, stop loss at 2250.
Okay, moving on then. Naresh, let's get in your top recommendations.
First would be a buy on L&T, good recovery here, stop loss at 2250 and a target price of 2500. Second is a buy on IndusInd Bank, continues to be in that 52-week high zone above the 1300 mark, stop loss at 1250 and a target price of 1450.
Coming in IndusInd Bank, but for now the market is holding on quite steady actually, 18,658. But do want to point out what's happening with Britannia. It's been quite, it's been quiet for the last many days and many weeks, but today it's breaking out. It's up around 3%, and ditto can be said for a lot of the FMCG names. Look at Tata Consumer, for instance. It's up around 2.25%. Nestle is higher by 2%, so that entire FMCG basket is doing well. And my guess is that Nifty FMCG should be at a fresh record high, given the fact it was trending record high levels earlier as well. On the losing side, however, it's Kotak Mahindra Bank, which is giving up. ICICI Bank as well as Bajaj Finance. So these are some of your top losers. From the broader markets, take a look at Suzlon because that stock is higher by almost 12%. The con call happened on 1st of June, but yesterday as well we got some fresh updates coming in. So maybe there's a bit of a reaction on account of that. RVNL is of course the reaction coming into the circuit filter. That's the reason that stock is higher by around 8%. And then Torrent Power had signed that big deal for the hydropower project. So Torrent Power is sitting higher by around 8%. On the losing side, Cochin Shipyard seeing a bit of profit booking, and similar can be said for Varun Beverages as well. But with that, we are stepping into a very short break. Don't go anywhere.